Be fearful when others are greedy, and be greedy when others are fearful. This is a very famous quote by the legendary investor Mr. Warren Buffett. And seems like we Indians have took his advice very much to the heart. Net inflows to equity mutual funds increased 22% month on month and has now touched 41,800 crores in the month of October. And this highest ever mutual fund purchase by retailers came in the month of the highest ever fall. So in October, we saw a fall of more than 6% in the last 10 years for the entire Indian stock market. Only 6 times or 6 months has the Nifty closed below 6% in red. So when FIAs are fearful, people are booking profits out of panic. The Indian mutual fund investors are starting to pump money into the market in October, and even in November, I'm sure we'll be seeing another record number here again. So these numbers are crazy. Mutual fund investors, that is you and me, we are investing record sums into the market. But I want us to do it the right way, and that is what this video is about. So in this video, we'll be discussing what are mutual funds. Then we'll be getting into what you should be understanding about mutual funds. What are the major points? These are for beginners. And then we'll be getting into 5 different ratios that you should be looking into while investing into a mutual fund. And we'll also be sharing a screener tool with you, with which we are implementing these 5 ratios, and the mutual funds which are coming up in that screener, we'll be sharing it to you in a Google Sheet. So I hope that you're ready with a pen and paper to understand what all are the exact things you should be looking at when you're starting your investment journey. So if that's the case, what are you waiting for? This is Ajay Ajith. Welcome to Market Feed. So first, let's start with what is a mutual fund, because I want this video to be very practical for anyone who is starting their investment journey. Or if you're already an intermediate investor and you know all these portions, I want you to be able to send this video to your friends who are just starting their journey. Right? So that's why I'm including all of this. Again, in the timestamps, I'll be very clearly marking which all are the beginner portions and which all are the advanced portions. So if you already know the concepts here, you can skip ahead into the timestamps given below. So what is a mutual fund? A mutual fund is nothing but a pool of money where different investors come together. They pool money to invest into various securities. That is, investors like you and me, instead of going and directly buying stocks or different securities, we come together saying that, hey, we'll place this money in a common pool, and from this common pool, we'll be investing into a diversified set of securities. When you're looking into these mutual funds, the first layer of thing that you have to understand is that they're divided into 3 major categories. First will be equity mutual fund. Second one would be liquid or debt mutual funds, and the third one would be balance funds. This is how the first layer of mutual funds look inside India. In India, mutual funds are run by very reputed companies in the financial sector. So for example, you can see companies like SBI running their mutual funds, companies like UTI AMC running their mutual funds, and also HDFC and a lot of private players as well. And this is a very heavily regulated market with SEBI as a watchdog. So if you have any concerns that if the money that you are investing into these mutual funds are going to be safe, you can trust SEBI, who is again a government agency who is set up to monitor capital markets and to safeguard investor interest. You can trust SEBI, and then you can start making your investments. So again, the market is always having a market risk. That means you might have always heard this. Mutual funds are subject to market risk. What does that mean? If the market goes up, your equity mutual funds will make you money. But again, if the market goes down, the mutual fund will lose you money. But that's not what I'm talking about. When I'm talking about safety, I'm talking about the entire ecosystem and the probability of scams or people running away with your money. In the past, there have been scams, but if you're looking at the number, it is very, very low and it is very well regulated. Any problems arising in this mutual fund space is looked at very seriously by SEBI. So I would say do not worry about it. So hopefully you understand that this world of mutual funds is a pretty safe place to be at. Now let's understand or get into each of these 3 categories, which are they? Equity mutual funds, liquid and debt mutual funds, and also balance mutual funds. So let's start with equity here. So equity means that your investments are purely going into stocks that are listed in the stock market. And this is also the most popular category among retail investors, because whenever someone comes into the world of mutual funds, they are often searching for the highest possible returns. And equity, often with the market being on a bull rally over the last multiple years, equity often gives you the best returns. So what happens inside this world? As we talked about earlier, you give money to a mutual fund manager or a mutual fund, and they intelligently pick out which stocks could go up and they try to invest in it. Again, they invest in your behalf, and whatever returns the investment generates, that will be passed back to you after some charges and cuts. So equity mutual funds will be investing into Reliance, HDFC Bank, Tata's, all of these stocks, and they'll be trying to make money for you. And the next category is debt or liquid mutual funds. These mutual funds often try to outperform FDs, and they're very much preferred by corporates in the country. So if equity mutual fund was highly preferred by retailers, debt mutual funds are mostly run by corporates, because you know that in a current account you get 0% interest, and often companies try to park their money into liquid or debt mutual funds. So what happens here? You're investing money into corporate bonds, government bonds, treasury securities, and likewise, all these are what you will be investing your money into. They have much higher safety and hence much lower returns. So in your portfolio, if you want a certain portion of it to be very safe, very steady in how it grows, you should be looking to invest that portion into debt or liquid mutual funds, and the rest can be in equity. Right? So I understand, or I hope that you understand this mind map of how equity works and what money you should be putting into it, and how debt works and what money you should be putting into that. So the third category is balance or multi-asset funds. So these will be investing into a combination of both equity and debt, and also sometimes invest into commodities like gold as well. But mostly balance funds are considered to be not so great. But for beginners, still it can be good, because you don't have to take any decision at all. The mutual fund manager will decide how much to put into equity, how much to put into gold, and how much to put into debt. So if you're a pure beginner who just wants some returns more than the FD returns that you're currently getting, you can think about coming into the world of balance funds. But for all others, I would suggest that you learn more and you upskill yourself on the world of equity as well as debt mutual funds. So now that you understood what a mutual fund is and what are the different major types of mutual funds, I also want you to understand how to deeply look at it, right? So as I said earlier, there are 3 different categories. You can invest in them for different purposes. So that's what I'll get into with this section, which is mutual fund planning. Again, this is a very complex topic, but I'll try to break it down for you. If your goal to, let's say, buy a car or buy a house or fund your children's education, that is very, very far away, you can think about increasing your equity percentage in whatever that goal's allocation is. So let's say you're planning for something that is 20 years away and you're starting your mutual fund journey. So for that plan, currently, you can think about having a very high equity percentage. Why? You know, in the long term, the market is very likely to give you the best returns, and you do not need it to be so steady because your goal is so far away. It is 10, 20, 25 years away. So you can think about investing most of your money, that is 90 to 95% of your gold money, into equity alone, and some rest you can still keep in gold for steadiness or in case of market fall. But if your goal is very, very close by, that means you want to fund a foreign trip that is just 6 months away, and in that case, equity should be generally avoided, because in cases just like where we are at right now, the market might take a downturn in the short term and you'll be stuck with losses. Again, in the world of FDs or in the world of banks, you might have never seen your invested amount going down. But in the mutual funds, you can see that, especially in the equity mutual fund space. We have made a dedicated video on how to plan your long-term investments and what percentage of portfolio should go into equity, debt. Everything we have very clearly planned out. I'll link the video here in the I button. You can go ahead and watch it. So just a thumb rule here, for long-term goals, you can consider larger portion in equity mutual funds, and for short-term goals, or let's say even emergency funds, you should consider a very high portion in debt mutual funds. So now that you understood what is a mutual fund, what are the 3 different major types of mutual funds and when to use them, right? Or when to invest in each of them, let's get into equity mutual funds a little bit deeper and try to understand active mutual funds versus passive mutual funds. So in the passive mutual funds world, you're investing money into indices like Nifty 50, Nifty mid cap, Nifty small cap, all of these different indices which track stocks without any human intervention. Right? So if you're talking about Nifty 50, these are the 50 largest companies in India by market cap. And there is no human deciding, saying that, hey, Reliance should be in Nifty 50, the other stock should be not be there. So it is just purely based on mathematical rules, deciding which stock should be included in Nifty 50 and how much weightage should be given to it. Right? So in a passive world, there is no mutual fund manager actively taking a decision. It is just a mutual fund tracking said indices like Nifty 50 or others. But on the other side, we have active mutual funds, which are trying to actively beat these benchmarks, right? Or these indices. So active mutual funds have people buying and selling stocks every single day to make sure that your returns or the money that you have invested with them is beating the benchmark indices. But just a point to note here, in most cases, in at least 50% of the cases, active mutual funds underperform these passive mutual funds. So make sure you have that in mind. Whenever you're going with active mutual funds, you need to put a lot of mind, thought and effort into picking the right ones. So now in this video, we are going to optimize for that major important question that is in the title and thumbnail, which is how do you find or how do you pick these active mutual funds? That's what everyone wants to surely know. That's the exciting part, right? Even though passive mutual funds might give you a lot of returns, safe returns for the longer term, but everyone knows that 50% of the time, there is some other asset called as active mutual funds which can outperform these passive mutual funds. So they want to go behind that. So we'll discuss it here. So then let's get into 5 different parameters that you should be looking into while selecting your mutual fund, while selecting your active mutual fund. And then we'll get into a screener tool or a way to visualize or analyze these 5 different ratios and numbers. And then we'll be getting into the list of mutual funds, right? That's what we'll be doing in this section. So this is the ticker tape tool. So it's a very popular website which is backed by Smallcase. And again, this is not a paid promotion. So neither Smallcase nor ticker tape have paid us a single rupee to be showing off this product or any of its features here. So let's get ahead. So first you'll have to get into the screener option here. So inside screener, you have 2 different types of screeners. One is stock screener as well as mutual fund screener. So we want to get into the mutual fund screener part. So click on more and you'll be seeing the MF screener here. So go ahead and click that and you can go ahead and click on the start screening button. So the first number that I want you to check here is the rolling returns filter. So again, going ahead, adding it here. Rolling returns. So what is a 3-year annual rolling return? It is nothing but a certain number which will help you understand how this mutual fund has performed over multiple holding periods in the last 3 years. So if you had invested on January 1st of a particular year, what would have been the returns? What could you have really expected from this mutual fund, regardless of whether you invested on January 1st, 2nd, 3rd, 4th, 5th, etc. By looking into multiple holding periods, this annualized rolling return will try to give you a number on the real returns of this mutual fund. And that's what we want to explore here today. This is a paid feature here. Again, for the sake of this video, I'm showing it to you, but I'll also be sharing the sheet with the filtered out mutual funds towards the end of the video. So make sure you check that out. So I want the 3-year annualized rolling returns to be at least 30%. But if we just look at plain returns, even if it's rolling returns, I don't think we'll get to an understanding of which is a good mutual fund. So the second number that I'm going to be adding here is alpha. So alpha is percentage outperformance over the fund over its benchmark. So let's say a certain large cap mutual fund who has its benchmark as Nifty 50. That means this large cap mutual fund is always being compared to Nifty 50. This fund manager will be trying to do what? As we said earlier, it's an active mutual fund. He'll be trying to beat the benchmark, which is Nifty 50 in this case. So by what percentage outperformance has this fund manager beat the index? That's what we are trying to understand here. So that is where alpha comes in. And here we can give numbers here. So I want the mutual fund to have an alpha of at least 2. right? At least 2. That means over the last multiple time frames, we should have, or we should see that this mutual fund is giving higher than 2% of what the index is giving. So the third metric that we want to bring in here is Sharpe Ratio. It is a measure of risk adjusted performance of the fund, calculated as returns divided by standard deviation of returns. Okay, so again, first we'll take the returns of this mutual fund, we'll subtract it compared to the risk-free interest rate, or whatever is the government bond giving in this current time, we'll subtract it with that, and then we'll divide it by the standard deviation of returns of this particular mutual fund. Again, it's a very complicated formula, but don't worry about it. We just want to add that filter here, and we want a Sharpe ratio of more than 1. That means for whatever risk this mutual fund is taking, it is giving good returns. So you can see that immediately the results went down once again. It is now at 264 results. So earlier it was at 800. Now it's at 264. And now I'm getting into the fourth point, which is AUM. Now, why is AUM even a discussion here? So we want a fund which has not very less AUM, because we want it to be trustable. We want a lot of people to put money into that fund. That's a very easy check there. But we also don't want a fund which is having extremely high AUM, especially for a small cap fund, right? So make sure you have that in mind. I'm just putting the minimum here, which is 5,000 crores. I want at least the AUM to be 5,000 crores, so that we immediately get from 200 results to 82 results. You see, all the very small mutual funds, they all got cancelled out. But make sure you have this in mind, that especially when you're investing into small cap and mid cap mutual funds, the AUM that your mutual fund has is not too high, because whenever the AUM is too high, they'll find it very difficult to recreate their past performances. Okay. So in small cap, large cap, you should also think about keeping an upper limit threshold. Here, I'm not adding that. And the fifth ratio is slightly controversial here. I'm not a big fan of it, but it's based on what a lot of people have asked me, which is a good mutual fund which has fallen a lot right now, which I should be thinking about buying. So that is percentage away from all-time high. That is the filter here. So I'm just adding that here. Personally, I'm not a huge fan of it because it says that your mutual fund has fallen by quite a lot and you're wanting to invest in it. But that doesn't make too much sense for me. There are arguments which says that this mutual fund manager will try to make all of that returns back on one side, and on the other side it says that, hey, simply the other one didn't fall, so that means it is better, right? So both arguments exist. I'm just putting it here so that when I click the export button here and I share the Google Sheet with all of you, you can at least have that in your column of consideration. So then I'll load all of this data into my Excel sheet right here, which I'll be sharing with you. Also, watch out for it in the description as well as a pinned comment, right? So I'll create a filter here. And first, let's say I want to understand only about small cap mutual funds. I can select the small cap fund here and I can understand which are the 10 small cap mutual funds which are satisfying my criteria. Again, next thing, what do I want next? I'll say I want flexi cap funds. Which are the 5-6 flexi cap funds which are following my investing style or my ratios that I wanted here? You can see that when I sort for flexi cap, it's very interesting, right? So Parag Parikh flexi cap, which I'm personally an investor in, it has fallen by only 4.86% from its all-time high. So when the market has fallen, Parag Parikh has actually not fallen by that much. But on the other side, Quant, again, I've invested in Quant mutual fund also. It has fallen by more than 13.9% from its all-time highs. So it's a very volatile mutual fund here. But you can think about having a middle ground here, which gives you the most highest average annualized returns with the best Sharpe ratio, with a great alpha, and has not fallen too much in this litmus test, which is a current market fall. So if you have to ask me here very bluntly, which all should you be looking into? I'll highlight these, right? Which is HDFC Bank. It has a high alpha, has not fallen by that much in the current market fall. It has high 3-year average annual returns, and Sharpe ratio also looks great. Parag Parikh also, it ticks all of our initial boxes. But here you can see that for the fact that it hasn't fallen by that much, even while giving a decent return of 22-23% average annual, I'll be very happy with Parag Parikh Flexi Cap also. Similarly, you can do a same study on all of your large cap and mid cap and different assets here, and you can take intelligent decisions on which mutual fund should be investing into. For example, large cap here, large cap 3-year annual returns. This is the highest, which is Nippon India large cap. It has not fallen by that much also. So again, you can understand that this fund gives you high returns over a 3-year period. The Sharpe ratio is good. It's 1.64. It's decent. Alpha, it's generating a lot of alpha, more than 2. And in the current fall, it has not fallen compared to its peers. So in the current world where everyone is running to buy mutual funds, be a bit more intelligent. Think a step ahead and use this sheet, right? Use this sheet and all the data that I'm giving you and all the rules that I'm giving you to make an intelligent opinion, to make an intelligent decision on where you should be investing. So I hope that this video gave you a lot of value. And if it did, make sure you hit the like button, hit the subscribe button as well if you want to see more videos like this one on the channel. And make sure you check out our previous podcast, which is mostly intended for casual investors who want to be updated on interesting stock market stories. So that's it for today. See you all again. Bye-bye.